You do not need a bomb to land near your house to feel the Iran war. You just need to check your grocery bill, your petrol bill, or your mortgage rate. That is the strange part of the Strait of Hormuz story. Most people think this is a war story. It is not. It is a money routing story. The controversy is clear. The U.S.-Israel-Iran conflict, renewed sanctions pressure, the U.S. blockade affecting Iranian oil shipments, and the crisis around the Strait of Hormuz. But the contradiction is this. The Strait of Hormuz looks like a shipping problem. In reality, it is a payment problem. Oil does not just move through Hormuz. Dollars move through Hormuz. Insurance risk moves through Hormuz. Government budgets move through Hormuz. And eventually, parts of your household bill can move through Hormuz too. How does a narrow waterway near Iran turn into a money trap? Before the war, Iran was already weakened. The World Bank projected Iran's economy to contract by 1.5% in FY 2026-27, mainly because of lower oil production, reintroduced sanctions, and tighter trade restrictions. That matters because a sanctioned economy has fewer cushions. It does not just lose trade, it loses options. Iran needs hard currency. When oil exports work, Iran earns dollars and other usable foreign currency. That money helps support the rial, pay for imports, and fund the state. But when export dollars slow down, the chain reverses. Oil export pressure reduces dollar inflow. Dollar shortage weakens the rial. A weaker rial makes imports costlier. Costlier imports push inflation higher. Think of it like a line of dominoes. The first domino is the oil route. The next is the dollar inflow, then the currency, then imports, then inflation, and the final domino is the household. Reuters reported that the rial dropped to $1,000 to $10,000 to the US dollar, falling nearly 15% in 2 days. For context, in late 2021, Reuters reported the dollar selling for about 382,200 rials on Iran's unofficial market. So the move to 1.81 million is not just a bad exchange rate, it is roughly 6 times weaker than that 2021 level. That is not just a currency chart, that is a price machine working against every citizen. If a business imports medicine ingredients, machine parts, phone components, or food inputs priced in dollars, a weaker rial means the local cost jumps. The importer pays first, the shop pays next. But the final payer is often the household. That is the first trap. The first payer is not always the final payer. Now add Hormuz. The EIA said the Strait of Hormuz is a major oil transit choke point, through which nearly 20% of global oil supply flowed before the military action began. So when Hormuz tightens, the world does not just watch a regional crisis, it reprices energy. But energy is a global auction. The war is local. The price discovery is global. Oil does not need to stop completely for money to move. Sometimes money moves because everyone fears the stoppage. That is the risk premium. The EIA said Brent crude averaged $107 per barrel in April, $46 higher than in February, and daily Brent prices reached $138 on April 7th. A barrel may still exist, but once risk enters the route, the price changes before the shortage reaches you. Now look at the physical side. The EIA said the strait would remain effectively closed through late May, with flows slowly starting again in late May or early June. It also said Middle East production shut-ins averaged 10.5 million barrels per day in April and could peak near 10.8 million barrels per day in May. That is production, storage, export capacity, and pricing colliding. If a producer cannot ship oil, storage fills, tankers hesitate, insurance gets harder, buyers demand discounts, and production gets shut in. So the blockade does not only hit the cargo that leaves, it can hit the barrel that never gets produced. Yeah, that is where Hormuz becomes a money trap for Iran. Iran can use geography as leverage, but Iran also depends on that geography to earn money. If the route is disrupted, global prices can rise. But if Iran cannot export enough volume, a higher price elsewhere does not automatically mean more money inside Iran. That is the two-option trap. Iran may gain leverage from the route and lose income through the same route. This is not a simple war raises oil prices story. It is a price, volume, route, and payment story. If the price rises but export volume collapses, revenue can still fall. If the buyer wants the oil but cannot insure the ship, trade can still fail. If the cargo moves but payment channels are restricted, money can still get stuck. The oil is physical, the money is institutional, and institutions are where sanctions do their quietest work. The IEA reported that in early April, shipments through the strait averaged about 3.8 million barrels per day, down from more than 20 million barrels per day in February before the crisis. Alternative routes rose to 7.2 million barrels per day. That sounds like rerouting solves the problem. But look closer. Those routes include Saudi Red Sea loadings, UAE Fujairah, the Iraq-Turkey pipeline from Tehran, and Iran's Jask terminal. These routes help. They do not fully replace Hormuz. The IEA says only Saudi Arabia and the UAE have operational crude pipelines that can bypass the strait, with an estimated 3.5 to 5.5 million barrels per day of available capacity. Iran, Iraq, Kuwait, Qatar, and Bahrain rely on Hormuz for the vast majority of their oil exports. That is why geography becomes bargaining power. Infrastructure becomes bargaining power. But the most dangerous part of this trap is not only the oil price. It is what happens to the money that does manage to get through. Because rerouted money is not clean money. Rerouted money is taxed money. And I do not mean taxed by a government. I mean taxed by the system. Wait, it gets crazier. People say sanctions stop money. No. Sanctions usually change the route, cost, timing, and discount attached to money. They make legal buyers cautious. They make insurers charge more. They make banks ask more questions. They make payments slower. They push trade towards smaller, riskier, more expensive networks. So the money may not disappear, it may reroute. But rerouted money is usually more expensive money. Imagine a money bag trying to travel from buyer to seller. First, it passes an insurer. A small piece gets cut off. Then it passes a bank. Another piece gets cut off. Then it passes a middleman. Another piece gets cut off. Then it passes a discount demanded by the buyer. Another piece disappears. By the time the money arrives, it is smaller, slower, and more expensive than before. That is the hidden toll booth. The visible sanction is only one cost. The hidden costs are shipping, insurance, finance, delays, discounts, and trust. Now bring this back to Iran's budget. When export money falls, the state still has bills. Salaries, subsidies, fuel, repairs, imports, reconstruction. With fewer external dollars, the choices become ugly. Cut spending, print more local money, delay payments, restrict imports, or lean on riskier export routes. None of those choices are painless. Now another twist. High oil prices create winners too. The IEA says non-OPEC plus output is set to increase by 820,000 barrels per day in 2026, helped by the United States, Canada, Brazil, Guyana, and Argentina. That does not fully replace the Gulf loss, but it shows the money shift. When Hormuz becomes risky, buyers do not just ask, who has oil? They ask, whose oil can reach us without crossing the trap? The barrel matters, but the route matters too. And in a crisis, the route becomes part of the price. Now think about households again. A weaker rial means imported goods become harder to afford. Higher fuel and transport costs move through food prices. Factory shutdowns hit wages. Government repair costs pressure public finances. Import restrictions reduce choice. And inflation becomes the final messenger. Reuters reported Iran's central bank put year-on-year inflation at 65.8% for the Iranian month from March 20 to April 20th. That is the money trap in human form. The household is often the last balance sheet in the chain. Governments absorb some pressure. Companies absorb some pressure. Banks absorb some pressure. But eventually, inflation distributes the pain across ordinary spending, quietly, unevenly, and often without asking permission. The future outlook is the loop. War risk becomes route risk. Route risk becomes export risk. Export risk becomes currency risk. Currency risk becomes inflation risk. Inflation risk becomes social and budget pressure. The EIA estimated that if the strait stayed shut through late June, crude prices would be more than $20 per barrel higher than its current near-term forecast. That is the global side. But inside Iran, the same event can be worse. A higher oil price helps only if you can sell the barrel, insure it, settle the payment, and use the money. If one link breaks, the headline price becomes less useful. Oil is not just energy, it is collateral for government budgets. It is foreign currency for import systems. It is pricing power for trade routes. It is insurance risk for shipping. It is inflation pressure for households. In a crisis, the barrel is only the visible object. The real story is the invisible chain behind it. The ship, the insurer, the bank, the buyer, the currency, the budget, the grocery bill. If this money mechanism still leaves a real finance question in your mind, drop it below. The best one may become the next money-explained breakdown. That is why the Strait of Hormuz became a money trap. Not because money stopped moving, but because every path for money became narrower, riskier, and more expensive.